Hello everyone and welcome to this week's episode of Kickstart Your Real Estate Investing. This week I'm going to talk about the next financial metrics, IRR, or called as internal rate of return. This is an important metric to understand because it's widely used by a lot of different investment companies and most of the investors. It allows you to take different kind of investment opportunities and measure them using a single metric. So you could be evaluating a retail strip mall or a multifamily building, and you could use IRR as a metric to measure what is the rate of return from each of those different investment opportunities and choose the one which gives you the most or the highest rate of return. So what does IRR mean? So if you really look at it, there are two parts to IRR. One is the internal part. What that means is that it is evaluated based on the things which you control, which are more internal to you, and things like inflation or the risk-free market rate or any of the other things which might affect things from an external point of view are not taken into consideration in this metric. So that's why it's called the internal rate of return. And the second part to it is something called the hurdle rate. Now, if you remember from the net present value formula which we used last week, there was something called as the discount rate. In this case, there is something called as a hurdle rate, very similar, but the concept is basically that there is a specific rate of return which is basically set as a hurdle, as in you have to clear this hurdle when you look at your returns on investment, and if it clears it, that is, it is equal or higher than the hurdle rate, that means it's a good rate of return. That means you can proceed. Now, whether it's your target rate of return is a different thing, which we'll discuss later. So the hurdle rate defines like what is the bare minimum returns you need to get for you to qualify this as an investment. And this concept came about, if you go back to the history of IRR, many of the big enterprises had a central financial department. And you had different lines of businesses which used to come to this finance department and request for funds. You could have one line of business come and say, hey, I need $5 million because I want to go and set up a factory which will allow us to increase our production and it will allow us to increase our revenues over time. You could have another line of business which will come and say, hey, give me $5 million. I want to take this money and I want to take our product into an entirely new market and we will increase our revenue. So if the finance department has to fund one of this investment, how would it do it? So what they use is IRR. So they say to both these lines of business that my hurdle rate for our company here is 8%. It could be the cost of capital, it could be its evaluation of risk, or whatever mechanism it might be, it will say the hurdle rate is 8%. So anything you do with this money, you need to show me that you're going to earn more than 8% rate of return for this investment you're doing. So both these lines of businesses will then go and they'll look at a projection of the future cash flows. They'll bring it to the current, like the net present value formula, and then they will also go and evaluate it for IRR. And once they come up with the IRR, it's basically that rate of return, whether you're setting up a new factory or whether you're entering a new market, those information is brought back to the finance team and then they can evaluate which is going to give them the most higher IRR. A point to note here is the finance department might also decide to go and increase the hurdle rate for a very risky venture if they see it that way. So if it means that one line of business comes and says, hey, I want to enter this new market and I'm going to come up with an entirely new product, the finance department might come and say, hey, this is a more riskier venture, so I'm going to put your hurdle rate as 10% instead of the 8% I always use. So that way they can also calibrate and see what is the rate of return which you can get from it. Okay. IRR formula, if you really look at it, it's behind the scene in Excel or any of the tools you use. There is already a formula which is set. The inputs which it takes the hurdle rate, that is which you define 8%, 10%, 12%, whatever the number is. It will take all your future cash flows and it will also take the money you are initially investing. So it has the same three things as a net present value. It has a hurdle rate or the discount rate. It has your cash outflows, which is the investment you're making, whether you're putting a new factory or buying a new building. And it has the list of all your future cash flows which are coming in. And you evaluate that, you pass that values into the formula, and then IRR comes back as a percentage value. If the IRR value is higher than the discount rate, that means it's a good investment. And then you can look at all the different investments and their IRR rates. And based on that, you can determine which is the highest rate of return you're getting, and that's the one you want to go and invest in. So if you look at last week's example, we had two investments, and in both the investment, we had the same amount of money which was invested. We had different cash flows coming in at different times, and then you at the end had a net present value where it shows that investment 2 is better than investment 1 because it has a higher net present value. Now if you take the same inputs and now plug it into the IRR formula, the internal rate of return formula, what it will do is it'll come back and give you a percentage. And if you look into this particular selection also, you'll see that your investment 2 has a higher rate of return than your investment 1. So that way you can say, if I'm going to invest in any one of them, I'm going to put the money in investment 2. So folks, this is the way you use the internal rate of return formula. This is the best way for you to evaluate very different kinds of investment opportunities and bring them to the present value and evaluate whether this is something which is worthwhile for you to invest based on your hurdle. Okay. Many times if you see and ask folks like, what is the rate of return you're expecting from this investment? It differs. Some might say I'm happy with between 12 and 15% of my internal rate of return. Some might say I may not put anything less than 20%. Every person is different. Every person can evaluate it differently. At the end of the day, if it is a more stable investment opportunity, which is less risky, your IRR will be lower most of the time because there is very less value for you to add things on top of it and make more money there. If it is a riskier venture, if it is a value add project, your IRR will be higher because you are expecting your cash flows, your future cash flows to be much higher than what it is now. Okay, so this is the way you can use the internal rate of return formula and look at all different kind of investments and choose the one which work for you. Okay, so this is it for this episode. Hope you like it. Please go ahead and like and subscribe to my channel, and I'll see you next week. Thank you.